Hello everyone, welcome back to Alt Invest. Today's video is going to be really interesting because we are diving into the only ETF in India that tracks a Sharia compliant index, the Nippon India ETF Nifty 50 Shariah BeES. This is the most asked question which I get apart from the mutual funds. Is this a Sharia compliant fund or not? We will explore what makes this ETF unique, the details of how it works, and also highlight some important disclaimers you must know. Before we get into the details, here is a quick reminder. If you're looking for a personalized ethical investment plan, whether SIP or lump sum, that's aligned with your goals like retirement, child education, or wealth creation, my WhatsApp link is in the description. You'll also find the number on the screen to contact me through WhatsApp if you're looking for help in terms of getting all of these. In the second part of the video, we'll also compare the ETF with one of the most popular Sharia compliant mutual funds in India, Tata Ethical Fund. We will look at advantages, disadvantages, portfolio overlaps, and the practical difference between investing in an ETF and a mutual fund. By the end, you will have a clear idea of which product may suit you and your investment styles better. Now, before we move into the detailed comparison with Tata Ethical Fund, here is something important which I want you to be aware of. I want to introduce you to RuPeeZ, a platform trusted by lakhs of investors for over 20 years to make smarter investment decisions. It's 100% AMFI and SEBI compliant. Account opening is free with zero AMC charges. And here is the value add. When you open your RuPeeZ account using the link in the description, you will also connect directly with me as your advisor. That means I can help you decide whether ETFs like Nippon Shariah BeES or mutual funds like Tata Ethical, Taurus or Quantum Ethical, or even a combination of both, best suits your portfolio or not. So if you're serious about building a Sharia compliant portfolio with expert guidance, get started on RuPeeZ today. Let's start with the first part of this video, which is the Nippon India ETF Nifty 50 Shariah BeES. Its simple objective is to provide returns that are closely corresponding to the performance of Nifty 50 Shariah index. It does this by directly investing in the securities that form part of this index in the exact same proportion. Now here is something very important. While this ETF invests in stocks that are part of Nifty 50 Shariah index, it does not declare itself as Sharia compliant scheme. Here you can see on the screen what is mentioned in their brochure as well. The AMC has made it very clear that there is no Sharia board attached to this fund and it does not follow any Sharia dividend purification process. This is a key detail because many investors assume that just because it tracks a Sharia index, the scheme itself is fully Sharia certified. But that is not the case. So where does the Sharia process come in the picture? This is done at the index level. The Nifty 50 Sharia index is screened and maintained by NSE Indices in partnership with Taqwa Advisory and Sharia Investment Solutions, TASIS. This is one of India's leading Sharia advisory firms. TASIS ensures that only companies that pass strict Sharia filters are included in the index. There are two layers of screening which they do for Sharia compliance. One, business screening, where companies involved in conventional finance, alcohol, tobacco, gambling or anything considered harmful are excluded. Financial screening, where limits are applied on things like debt, interest income and receivables. So the company's financial structures remain within acceptable Sharia threshold. Let me pause here and introduce you to the workshop which I have created specifically for investors who are looking for getting knowledge about Sharia investing. In this course, I detailed about the various types of investments which are available in Sharia, how we can start investing by yourself, explored mutual funds, stocks, and also gold and silver. So if you're someone who's looking to start your Sharia compliant investing or already investing and would like to get a deeper understanding, do check out the course which I have built specifically for Sharia investors. The link and the details of it are available in the description. So effectively, while the ETF itself doesn't claim to be Sharia compliant, the index it tracks is carefully curated to Sharia compliant. Let's look at some numbers. As of July 2025, the top holdings of Nippon India ETF, which is the Nifty 50 Shariah BeES, includes Infosys with a over 20% weightage, TCS is around 12%, Hindustan Unilever is about 8.4%, Sun Pharma is 7%, HCL Tech is at 6%, and then we have also names like Ultratech Cement, Tata Motors, Asian Paints, Nestle India, which feature prominently. You will notice this gives investors exposure to a diverse set of sectors: IT, FMCG, pharma, auto and cement. Let's break it down to understand the performance in detail. If you had invested 10,000 rupees 1 year back, the value today would be around 8,534, which is a negative XIRR return of minus 14%. The benchmark Nifty 50 Shariah TRI also fell, but slightly smaller margin of 13.8%. This shows that in volatile phases, the ETF mirrors the market downside quite sharply. Over the 3 years, the same 10,000 would have gone to 11,854, which is a 5.8% CAGR. Not very high, but still positive despite markets' ups and downs. Over the 5 years, the returns look much healthier. The same 10,000 rupees would be worth 17,411, which is translating to an annualized return of 11.7% in CAGR. If you look since the inception in 2009, the ETF has compounded at 13.15% CAGR, turning 10,000 rupees into 75,600. This is lower than the plain Nifty 50 TRI, which has delivered closer to 15.6% CAGR. But that's the trade-off with Shariah screening. You restrict certain companies and sectors, which sometimes means slightly lower returns as well. So the key takeaway is over the long term, despite short-term volatility, the ETF has delivered double-digit growth and stayed quite close to its benchmark. Let's also understand how you can purchase this ETF. Investing in this Nifty 50 Shariah BeES is flexible and there are two routes. Through the stock exchange. Just like you buying a stock, you can purchase even one unit. The transaction is done at real-time market price. Settlement happens T+1 and there is no paperwork. This is the easiest option for retail investors who already have a demat account. So the demat account is mandatory if you're looking to purchase an ETF. Through AMCs. This is for large investors, market makers or authorized participants only. They can transact directly with the AMC but only in blocks of 10,000 units. Similarly, redemptions also follow the same structure. For normal investors, you can sell on exchange unit by unit, but you ensure that all the transactions are done during the market hours. Large investors can redeem with the AMC in multiples of 10,000 units. So retail investors really benefit from the stock exchange option. Low entry point, high liquidity and full transparency. From a performance perspective and investment process, this ETF gives you a low cost, transparent way of investing in Shariah compliant, large cap Indian companies which follows the index. But with the caveat that it does not itself claim to be Shariah certified scheme. Now let's do a comparison with Tata Ethical Fund, one of the oldest and most popular Shariah compliant mutual funds in India. It's an open-ended equity fund that has been around since 1996. While the ETF tracks Nifty 50 Shariah Index, Tata Ethical Fund follows Nifty 500 Shariah TRI as its benchmark. This means it has much wider investable universe. Mid caps and small caps also come into the play, unlike ETF which is strictly large cap. When we look at performance, Tata Ethical Fund has been strong over the long term. A 10-year SIP would have generated close to 13% CAGR, slightly outperforming the benchmark. Over the very long term, since inception, returns have been even higher at nearly 17% CAGR. This shows the advantages of active fund management and stock selection, which is available in a Tata Ethical Fund. Portfolio-wise, there is definitely an overlap. Both have top holdings in TCS, Infosys, Hindustan Unilever, Ultratech Cement and HCL Tech. But Tata Ethical Fund goes beyond just the Nifty 50 names. You will find exposure to companies like SRF, Cummins India, Alchem Labs, Shree Cement and BBCL, which are not part of the ETF portfolio. Advantages of ETF, it's low cost. Expense ratio of ETFs are significantly lower than an active mutual fund. It provides instant diversification with large cap leaders only. Liquidity and transparency are very high. Advantages of Tata Ethical Fund, it has a wider investment universe with mid cap and small cap exposure as well. Active management that can capture opportunities beyond the top 50. Long track record with consistent performance. Let's look at the disadvantages of ETF. Limited to Nifty 50 companies only. No exposure to potential mid-cap growth stories. No Shariah purification process is followed at the fund level, which is at the ETF level. You need a demat account to invest and trade in it. Unlike a mutual fund, which is simpler, for which you don't need a demat account. You just need a savings account and an account with the AMCs. Disadvantages of Tata Ethical Fund, it has higher expense ratio, both for a direct or a regular plan. It is of course slightly higher volatility due to exposure beyond large caps. Another big difference is in the requirements for investing. ETFs requires demat and trading account and you buy them at real-time prices during market hours. Mutual funds on the other hand can be bought with just a simple SIP mandate through any AMCs or a distributor with no demat required. For many retail investors, this makes mutual fund much more easier and convenient for to invest. So which one should you choose? If you're someone who wants a low cost passive option, is comfortable with a demat account and prefers sticking only to the largest companies, then the Nippon India ETF Nifty 50 Shariah BeES could be a good fit. On the other hand, if you want a broader market exposure, professional management and the convenience of traditional mutual fund investing, Tata Ethical Fund may be much more suitable. Both have their place and many investors actually use them together. The ETF for cost-effective core allocation and Tata Ethical for active exposure into a larger universe. What do you think? What would you prefer, a passive ETF route or an actively managed Tata Ethical Fund? Share your thoughts in the comments below. I would love to understand what your views are about this. And if you're serious about building a Sharia compliant portfolio, feel free to reach out to me at the number which you see on the screen. You'll also find in the description the WhatsApp link. That's it for today. Don't forget to like, share and subscribe to our channel Alt Invest for more such insights on ethical and smart investing. Thank you for watching and have a good day.